I heard something about the Bengals and some historical reference you got, brother. What is it?
Well, let's give a little love to Joe Burrow this morning. I'm rooting for the Cincinnati Bengals. It's because I'm from the Midwest, Sully. Nothing against my folks out in L.A., but Joe Burrow, I think he will be smoking a cigar after that game. But if you look at 1982, that was the last year we had inflation readings to the extent we have. So economists are forecasting this Thursday CPI to be 7.3%. That was actually the last time the Bengals were in the Super Bowl. So a lot going on here this weekend, no doubt about it. But I think this inflation component, that really distracted markets. We've heard so much from Fed Chairman Powell. We've seen so much talk about interest rate hikes. Now we're hearing from some folks, it goes up every day. 5 hikes, 6 hikes, 7 hikes. I'm not in that camp, Sully. I think it's
ridiculous.
A 1-2 punch.
No.
It absolutely is. And that's from a lot of academia, a lot of folks who've never managed money. But I do see 2 to 3 hikes. And I think the Fed has something going on their side. For the first time, we've seen just a little bit of slowing in used car sales. So I think inflation does come off. They are going to be forceful. They did change their rhetoric. But at the end of the day, the ironic thing here, Sully, is that the Fed is still buying. They're buying $30 billion this month. So it is kind of almost you want to chuckle a little bit to see how this shift has happened so fast. But I am constructive. I am positive. I think we're, again, back focused on earnings. And earnings are mad because dividends are being paid out, buybacks are happening, and strength overall in earnings, the beats that we have seen. It's really optimistic and positive. So I know there's a ton of volatility. I know it's going to be quite the battle on Sunday with Joe Burrow. But nonetheless, I am betting, and I know you've been betting on Twitter a little bit, so let's maybe have a little side bet, a little stake in New York.
Winning.
It's been a while.
No, because I'm on your side, brother. I'm 15-2 in FanDuel, by the way, so I'm buying. I just want to be honest. I laid money down, not Kernan money, real money. Sorry, Joe. At Bengals 4.5. I think that half point's going to be key, but I'd love to see the Bengals and Burrow's magic win, by the way. As a Chargers guy, can't get behind the Rams. Anywho, that aside, we just talked about the bond market, Jeff, going down. Yields are going up. How does that impact stock investors? They're watching that RBI going, Sully, that wasn't very good. But it matters. That's why I brought it up.
It does matter. Look at LQD. Look at HYG, corporate bond ETFs. Big slugs of money. We're talking about $35 billion in each one of those ETFs. And yes, they're down 4 or 5% year to date. So it does make a difference. It's the velocity. We talk about this a lot here on your show, Sully. The velocity of the bond move. I don't see the 10-year note going above 2%. I think it'll be short-lived over 2%. We have to digest this change in rhetoric. Again, the Fed is still accommodative. Their balance sheet, it's at $9 trillion. If they go back to the way that they were reducing their balance sheet back in late 2017 of $50 billion a month, let's just say they double it, Sully, to $100 billion a month. In 12 months from now, they're still going to be at $8 trillion. So that accommodation, that liquidity, and that's one thing that's really been revealed, Sully, this earnings season. We are seeing corporate America flush with cash. We're seeing banks flush with cash. So this cash, yes, it could cause some problems when we have to pull it out, but there's no way the Fed is going to make a misstep. I know they're beating their hawkish chest, but it's not going to happen to the extent they are. They're just talking tough.